Hugh, there's a bunch of different places we could go, but I want to start on your kind of theme or idea here, which is that we need three conditions before we have the all clear for the stock market. And how many of the three have been met so far?
Well, not much of them. You're moving a little bit in the right direction. First thing you've got to have is you got to have good performance, bull market type performance from the equity markets, and we're not seeing that yet. Yes, the S&P is going up, but when you take a look at sector performance, we still see some of the defensive sectors are doing the best, like healthcare doing good, doing well, staples doing well. We're starting to see a little bit of a change there, though. We are seeing consumer discretionary, technology stocks, and communication services stocks do a little bit better. The second thing you'd like to see is you'd like to see some really good news, or you'd like to see the market performance be in response to good news on the pandemic. We're getting a little bit better news. There's some encouraging news, but quite frankly, it's not far enough along.
Okay.
And the third thing you really want to see is you want to see the market being priced right. In other words, it has to be undervalued, and you have to have widespread pessimism. We have to be sort of at an emotional extreme. And quite frankly, we're not there yet. We're still a little bit pricey or overvalued, about 9% overvalued over the level I think we're going to bottom out at. And the level of pessimism is a little bit high. So you've got three conditions. We're starting to move in the right direction. Things are getting a little bit better, but we're not there yet. I still think we've got about 9% left on the downside in the S&P 500 as a guess in an uncertain environment.
Okay, and you say because of everything that you've just described, you want people to be defensive, overweight large cap equities, consumer staples, healthcare, utilities, and so forth. So, Paul, kind of keying off of that, we are obviously going to hear a lot more from companies this week with earnings and so forth. I mean, are you learning a lot from that? Are we finding out who has the stronger balance sheets, and are we getting real insight on trends in the economy or not?
We're not getting a lot of new information on terms of who has the quality balance sheets. We already had a good, strong sense that was going to be found in consumer discretionary, tech, and comm services. Those are the results we've seen from this earnings report, this earnings season. We have a sense that analysts on the street are still too high with their earnings numbers. So could be some choppiness in equity markets coming up.
Yeah, so this week, we've sort of passed through the big tech companies. It seems like some of the excitement is out of the air. You would be unfavorable on industrials, materials, energy, and so forth. So, again, there seems to be a lot of consensus around, be in the parts of the market that everybody seems comfortable with and avoid the names that are out of favor. Paul, perhaps the most striking thing to me as well is what Bob Bassani mentioned, which is that Warren Buffett, Berkshire, they're not buying anything here. They've been talking for years about waiting to pounce on a big market opportunity, and maybe no one's come to them with one yet, but they certainly haven't moved yet, have they?
No, they haven't, but we do think this is an environment where you can put money to work. We do see valuation, a good value in financials. We think there will be a rebound, and financials will benefit, and the yield curve will eventually re-steepen. We like that play. We also recently moved into healthcare out of real estate, so we think that's another one that you could move into. And I'll finish by saying, look, you've got some high performers that are driving the market right now in tech, in comm services, and consumer discretionary. We think they continue to drive this market going forward, not just because of their size, but because this is the stay-at-home environment that we're in right now. Those companies will continue to be favored.
Then, Hugh, final word. Would you also be a buyer of the so-called stay-at-home stocks?
Yeah, you know what I would be buying, and I'd be buying, I just starting to buy sort of the bull market sectors. Paul mentioned it. We're talking about consumer discretionary, communication services, and technology. I'd start to get a foothold in those stocks because one thing that's true about this pandemic and this bear market, and what's true of all bear markets and all pandemics as they end, this one, in my judgment, is going to end either in the third quarter or the first quarter of 2021, and you have to have some bull market stocks for that. And the ones Paul mentioned and the ones sectors I just mentioned are the ones you've got to have. So start to buy those sectors.
All right.